What's a liquidity sweep? Don't enter a trade just because the price hits a support level. That is where retail stop losses are clustered. Wait for the liquidity grab. Retail stop losses are usually hidden just below the recent lows. This move is called a liquidity sweep. This is not an entry signal. Find the zone. After the sweep, look for a change in the state of delivery and identify your zone of interest. Enter on the pullback. Don't FOMO. Wait for the price to pull back into your point of interest and enter with a high risk to reward ratio. Always check these 3 things before you open a trade.
1.
Has liquidity been taken? Price needs fuel to move. This fuel comes from stop losses hiding above obvious highs or below obvious lows. If the market hasn't grabbed this liquidity, the move you see is probably a trap.
2.
Is there a change in character? After the liquidity is taken, the price must strongly change direction. It should break a clear high or low to prove it is reversing. If the structure doesn't shift, do not trade.
3.
Is there a fair value gap in the right area? It isn't enough to just find any gap. It must show up before the market changes its structure. If all 3 are true, I enter the trade. This is how you stay a trader instead of becoming a gambler. Here is my 80% plus win rate model. Identify the liquidity sweep. Watch for a sharp spike below a low or above a high. Retail traders get stopped out here. That's your first sign. Identify the bearish fair value gap and wait for a candle to close above it. This shift turns that gap into an inversion fair value gap, signaling a change in market intent. This is the trigger we're looking for to enter long position and target the nearest buy-side liquidity. Master this setup and you'll stop being the liquidity and start trading with it.